JP Morgan has announced plans to include Saudi Arabia, Kuwait, Qatar, United Arab Emirates, and Bahrain, all of which are members of the Gulf Cooperation Council, in its flagship emerging market debt indices starting from January 2019. These will cover conventional bonds and sukuk, or Islamic bonds. Historically, these countries had not qualified for inclusion in the JP Morgan indices due to their high levels of income per head, as well as, with the exception of Bahrain, their highly rated sovereign debt. However, most investors would agree that these countries share many characteristics with emerging market economies. To make them eligible for inclusion, JP Morgan has introduced the purchasing power parity ratio as a new parameter for selection. Countries with a ratio below 60% will now qualify as emerging markets, even if they don't meet the other criteria. This adds flexibility in the selection process, but by the same token, it also makes it more difficult for countries already in the emerging market index to be upgraded to developed market status. The inclusion of the GCC countries will be done in monthly stages through to September 2019. And by the end of the process, the combined weight of these countries is estimated to be between 10 and 12% of the index. This will significantly boost the representation of the Middle East region in the benchmark, but will also require the index to redistribute the weighting of other regions. Most of the money in emerging market bond passive mutual index funds and ETFs is actually linked to JP Morgan benchmarks. Also, these are the indices of reference for the vast majority of active funds in the space. So we may expect a comprehensive reconstitution of portfolios in 2019. Overall, the inclusion of the GCC countries is a welcome development. Over the past decades, these countries have become very active issuers in international government bond markets as they try to diversify their economies away from heavy reliance on fossil fuels. In fact, 2016 and 2017 were record high years for bond issuance for these countries. This will make the JP Morgan indices more representative of the emerging market universe. It will also increase their overall credit quality and potentially decrease volatility.